So director loans or shareholder loans, all called Division 7A loans. The reason we have Division 7A is because what people used to do is instead of paying a dividend from a company, because that becomes income for the shareholder, they would just take a loan, because a loan is not income. A loan you have to pay back. And in the mid-90s, this finally got put to a stop and Division 7A was put in, which said that certain transactions with companies that you're associated with are taxable. So two main kinds of transactions that you deal with are going to be Division 7A payments and Division 7A loans. The upshot of Div 7A loans is that you must repay it principal and interest, either 7 or 25 years maximum, 25 years if it's secured by property, 7 years if it's unsecured, and you have to charge the baseline interest rate. Currently that interest rate is 8.3%, I think. It's like the small business mortgage rate published by the ABA plus 3 basis points or something like that. And if you don't make that minimum yearly repayment, then that repayment that you should have made is deemed to be a dividend. And deemed dividends are income and you can't use the franking credits. And you know how much we love franking credits. The other one, less important, is Division 7A payments. Now, Division 7A payments, you can actually turn in to a loan. And the reason that you want to do that is a Division 7A payment is just a full-on deemed dividend in the year that it was paid. So if before, when you lodge your tax return, you put that payment on complying Division 7A loan terms, so that's the 7 or 25 years and the baseline interest rate, then it's considered a Division 7A loan and not an immediately taxable payment. Now, if you lasted this long, you should know the reason why these are so powerful is that you can use temporarily tax-free funds or corporate tax funds only from your company to build capital value for yourself or in a family trust. You can create a lot of wealth this way without paying significant dividends all up front. Because the difference between 25% sort of small business company tax rate and the top marginal rate of 47% is a lot. And if you can save that tax, you've got more money to make more money as long as you can manage those Division 7A payment terms. And if you can't, that's when you have a real problem. So you've got to be very careful taking out Division 7A loans. Often you're going to fund the repayment of that loan by paying a dividend from the company, so you've got income, and then repaying it back to pay back the loan. Everybody who watched this video is now more knowledgeable on Division 7A than 99% of people in this country.